Morning, everyone. We've had some turbulent weeks when it comes to interest rates as of February. So we've got the most recent data, how that's affecting home buyer demand, new construction sales data, as well as an update on the interest rates themselves, as well as a projection on what the heck is going to be happening with these things moving forward and what could the Fed possibly think or do as a reaction to this. We've got all that and more in this week's episode of The Bottom Line. Good morning, everyone. And wow, what a week it has been. I'm glad to be here with you this morning to break down the numbers through the different reports we got from the housing market last week. So without further ado, let's go ahead and get started on what drives the market, which is home buyer demand and interest rates. Last week brought us the highest rates we've seen all year. We saw the rate for a 30-year fixed rate conforming loan increase from 6.39% to 6.62%. And what hurts more is this is the second consecutive week of interest rate increases in just the last 2 weeks. We saw the rate skyrocket, to be frank, from 6.18% up 44 basis points, so up 0.44%, up to 6.62%. So let's dig in here and begin to understand exactly what is happening right now. To keep it simple, the market is reacting to the rise in treasury yields. Basically, the market is concerned that due to recent, hotter than expected economy data, which drives inflation, the Fed would need to keep their monetary policy more restrictive or restrictive for a longer period of time. Everyone's favorite topic, rate hikes. Let's switch gears here a little bit and take a look at how home buyer demand is facing in the face of these new rates. Last week, we saw mortgage applications continue to plunge. Applications to purchase a home sank 18.1%. So safe to say home buyers are not feeling it when it comes to the new interest rates. But so far this year, we've seen ebbs and flows for mortgage applications. It's seeming like the market for 2023 may be very sensitive to interest rates. Back in the beginning of January, we saw a surge of mortgage applications going up nearly 35% from the prior month, only to begin to crumble here in the beginning of February, being down 21% over the last 2 weeks, losing a lot of the early gains we had made in the beginning of the year. Now let's dig into why all of this happened. Last week, we got the Fed's favorite measure of inflation, personal consumption expenditures, aka PCE. And this showed that inflation rose in January. And of course, this is no bueno. The main reason why mortgage rates are so heavily impacted by this is the residual concern within the markets that the Fed will either need to increase their Fed funds rate further, or they're going to continue to keep their interest rate elevated for a longer period of time. And largely, this is going to be based off of their comfortability with what inflation is doing. When inflation continues to rise in the face of all these rate increases that they've already done, it definitely puts the ball in their court as how they want to approach it. And if you really want to understand what they're trying to do, it's an incredibly difficult thing to get correct. I mean, they're using only lagging data and indicators and reports to show what the market has done over the past couple of months and uses that to try to steer the ship moving forward. Now, you can imagine this could run into quite a few issues if your focus is solely on the rearview mirror and you're trying to move forward in real time. Though there is hope on the horizon, and we do expect over the next couple of weeks, by maybe the same time, this time next month, that we could be getting much more friendlier job data on March 10th and much more favorable inflation data on March 14th. So agents, keep this in mind when you're talking with your buyers and you're talking with your sellers. If we're correct on this, we should see some nice improvements to rates in the beginning of April. And this ain't no joke. All right, so anyways, let's switch gears and now take a look at new home sales. I think it's definitely an interesting thing that we keep tabs on of what's going on in the new construction realm, as this tends to be the price leader and tends to be the trend setter for what's going on in the housing market. And when we look at and dig into the new home sales, which measures signed contracts on new homes, this rose 7.2% in January to a 670,000 unit annualized pace, which was much stronger than estimates and follows a 7.2% gain in December, although year over year, we still are seeing sales down 19.4%. And a big part of this is not having a lot of homes completed and ready to buy. I know when I'm working with home buyers, I mean, especially first time home buyers, it's an incredibly intimidating process. And they want to be able to look and touch and feel the product that they're buying. And when you look at that, out of the 7.9 months of supply that's out there, only 15% of that is actually completed, which means in reality, you've got about 1.2 months of supply to consider. Now, overall, when we look at the data, this is the second strong report in a row that we've gotten from builders in the new construction space. So that begs the question, how are builders having success in this type of environment? Well, when you listen to the earnings calls from the largest US builders, over 60% of them cited incentives, things like seller credits, paying points, 2-1 buy downs. These will be very interesting to see how this affects the rest of the market because most traditional homeowners see these types of incentives as weakness among homeowners. But times are definitely changing. And if nothing else, I think we can entirely agree that 2023 has been absolutely rate driven. And it's going to continue to do so. So throughout the remainder of this year, we're going to continue to bring you the latest and greatest market data so that you can stay up to date as an educated professional in this space and give your clients, buyers, and sellers the best advice as we continue to navigate this year moving forward. So we appreciate you taking a couple of minutes on this Monday morning to tune in with us here and get the most recent episode of The Bottom Line.